All right, we're going to get going. We'd like to welcome everyone and thank you for joining us today. My name is Josh Gerch and I help lead the capital markets practice at Workiva. And we're really excited to have you join our discussion today where we plan to talk about IPOs, discuss the IPO window, market conditions, deal readiness, and the role of AI that we're seeing in the IPO process. Before we dive in, I want to cover off on a few housekeeping items that we have today. The first one is that this webinar does qualify for CPE credit. So if you're looking to receive CPE credit today, we'll be asking or putting up 4 multiple choice questions throughout the webinar. In order to qualify for CPE credit, you need to respond to at least 3 of those questions and attend the duration of the webinar. Following the webinar, you'll receive a certificate that you can download on the On24 platform, this one, or there will be a follow-up email sent within about an hour of the ending of the webinar where you should receive your CPE certificate. Additionally, I'll call out that there is a Q&A box in this platform where we encourage you to ask questions throughout the webcast. You can submit them directly on the tool. Today we have a lot to cover, so we don't plan to take any time for Q&A, but if you'll submit questions, we will respond later via email. So please know that we do appreciate any questions. We will capture them and we will respond to them today. So with that, we're just going to kind of jump in. And before we jump into our discussion today, I think it's helpful to just step back and look at the arc of the IPO market over the past several years. If we rewind to 2020 and 2021, we were in what was probably arguably one of the most active IPO markets that we've had in decades. Capital was abundant, valuations were strong, companies across sectors from high growth technology to consumer brands to booms in the SPAC and SPAC sponsored deals were all accessing public markets at a very rapid pace. Following 2021, we did see a big shift in the environment. From 2022 to 2024, the market entered what we would maybe consider a prolonged slowdown. There were a change in macroeconomic factors, rising interest rates, geopolitical dynamics, valuations, resets occurred through that time. And so for many companies, if you were thinking about an IPO in that era, the window didn't fully close, but it became extremely selective. What's exciting is over the past year in 2025 and heading into 2026, we've started to see that environment change again. We've started to see activity return. We've seen several successful offerings across sectors. We've seen SPAC IPOs reemerge and just a growing pipeline of companies looking to access public capital through the public markets. I'm not sure we would necessarily say it's a full reopening of the floodgates for IPOs, but it's a clear signal that the market's moving again. As we head into early 2026, it seems that the pipeline and momentum continue to build, and there seems to be a lot of pent-up demand from companies who are waiting for the window or trying to take advantage of this open window to go public. And advisors, I know ourselves, Workiva, we've had a huge increase in pipeline in supporting IPOs, and other advisors in the ecosystems, accounting firms, law firms, bankers, we know that they're feeling that activity as well. So with that brings some challenges in timing, how you prepare, how you think about execution are kind of becoming more important than ever in 2026. And there's some considerations to consider. And that's what we're here to talk about today. So to help us unpack that dynamic and shed some light and insights on that, we're joined by 2 experts who spend their days working with companies that navigate these types of transactions. First, we have Sherry, who comes from KPMG, who brings deep experience in advising companies through this IPO and helping them navigate these conditions. And we're also joined by Chelsea, who works with Workiva with our public company base and works with our customers as they transition into public company life and deal with the challenges around SEC reporting and compliance. So Sherry, Chelsea, thank you for joining us today. And just to get us started, I'd love to turn it over to Sherry, you first, and then Chelsea, and maybe you guys can give us a brief introduction of yourselves and share a little bit about your background and what you do.
Yeah, absolutely. Thank you for having me. Really pleased to be here. So as Josh mentioned, I'm a partner at KPMG and I lead our global capital markets readiness offering for the firm. And so that means bringing together the breadth of expertise that KPMG offers across audit, advisory, and tax, and really helping clients in that pre-IPO to newly public journey across a broad spectrum of areas where companies typically need to upscale their capabilities. My background is in accounting and reporting, but we certainly bring a lot of expertise, not only around reporting, but think also governance, controls, people, processes, technology. So happy to be here today and really looking forward to the discussion.
Great, and I'll go also thank you, Josh, for including me in your P2P webinar. As Josh said, I'm an industry principal with Workiva, and I more focus on our financial reporting solutions, especially those post-going public financial reporting solutions. So looking at SEC reporting, SOX reporting, multi-entity reporting, and management reporting. I started my career with PwC. I was there for 8 years before moving to industry, where I've worked as both a director of SEC reporting, and I've been a vice president, corporate controller over a global company where I oversaw over 130 accounting employees.
Yeah, we're excited. We're excited to hear your insights today, and thanks for taking the time to join us. Before we get going, I'm just going to put up the first CPE question for our audience. So these will be up for approximately 2 minutes. So take a time to look at them, review them, and please take a moment to respond to them. I think the first one kind of highlights what we want, maybe our first topic discussion that we have today. And Sherry, I'll direct this to you, because I think if you're looking back at 2025, we would love your insights on how would you characterize that IPO market? Is it a true reopening, or does it remain still highly selective on who might be able to go through a public offering in the time and the window that exists today?
Yeah, absolutely. I mean, I would say that we definitely saw a significant resurgence in activity in 25 compared to years prior to that, at least, since 2021. It certainly felt like a reopening. I think every year progressively has gotten, more and more active. But I do think it's important to understand that I would really characterize it as, I'll call it a flight to quality. So the window did open, but I feel like it was really only for those companies that were well prepared. The investor appetite was strong for IPOs, but I think still discerning. So companies were being prioritized if they had, proven business models, clear paths to profitability, and strong corporate governance. So the way I might characterize it is less of a, wide open floodgate and more of a selective environment where high quality issuers with compelling stories were really the ones to succeed. So still a selective market, but definitely feeling the uptick in momentum.
Yeah, I think we would agree and, kind of support that analysis as well. We experienced similar things, or kind of a similar viewpoint. We saw a significant increase in IPOs year over year. I think it was up, 30 to 40% roughly, if you look at the number of transactions of IPOs. So there was more activity, but to your point, it seemed like you needed it seemed like companies that were on that path of profitability, had strong growth, had good governance, were in kind of an operational readiness phase to go through this. And to your point, I think about having a strong and clear equity story was really the companies that we saw were able to take advantage of 2025. It is interesting, to your point where you talk about you're feeling it, and I think we've mentioned the same thing. We're starting to see that uptick. It definitely feels like that activity is there, of people working in that pipeline to get ready to it. I mean, it brings up just feeling that, that dynamic, or what we see in pipeline, from your vantage point. Are there certain sectors that you're seeing, where they moved in 2025 and they continue to move in 2026, or are there certain sectors that you believe are best positioned to move? And maybe adding on to that, are there certain types of, sponsored companies that are coming to the market now, PE-backed, VC-backed, mega deals? Just curious your perspective on pipeline, on the industry factor, on the sponsors, what you're seeing moving, what you've seen move, and not like too much of a forward-looking statement, but just your insights on what the opportunity might exist for 2026 in those areas.
Yeah, absolutely. So certainly there were sectors that saw pretty important growth in 2025. And I guess I'm always a little bit biased towards technology because that's the industry where I spend the bulk of my time. But certainly technology was back in 25 because it had been quieter than what I would call normal previous to last year. And certainly companies that had an AI or an enterprise SaaS focus tended to be fairly dominant in that sector. Also, we saw a fairly significant increase in industrial manufacturing. And so I think a lot of that was driven by investors being interested in, themes like supply chain resilience and domestic production, especially with, what's been going on in our macro environment. And then, I know those who are focused on the healthcare and life sciences sector were certainly pleased to see life sciences come back. And so really an indication of continued innovation and I think a really resilient investor base are some of the things that kept this sector active. And frankly, we expect to continue to see that in 2026. So if I think about what's coming, right, and putting on a little bit of my crystal ball, we certainly look at companies that we are aware of that are in the pipeline. And so we certainly have some insights, both from who we're working with as well as what you hear in the market. Definitely, a day doesn't go by where we don't hear about AI, and I think that continues to be a dominant theme with investors having significant appetite for companies that have strong foundational models and really are focused on AI native software and data platforms. So I expect we'll see a lot of that in 26. Clean tech and energy transition. So if you think about companies focused on battery technology, recycling, new energy sources, I would say those are gaining momentum. And a lot of that is driven by policy as well as the demand for infrastructure to support the AI boom. Similar to what we saw in 25, I do think biotech, life sciences, healthcare, that'll continue to be a sector where we see, strong innovation and I think resilience that supports an uptick in, IPO activity. And then finally, maybe aerospace and defense. I think just given our geopolitical trends, companies in space technology and defense are, increasingly prominent in IPO discussions. So I think the good news is we're seeing activity across all sectors. There really is pent-up demand, but those would be, at least from my perspective, some of the key industries that we expect to see movement in. And then coming to your question on like the types of issuers, definitely PE-backed companies, I think, are very well positioned. We're still coming out of a period where PEs have been holding on to their portfolio companies, longer than what would be expected to be typical. And I do find that those companies tend to be, larger size, have more mature financial processes, and really a clear focus on profitability, which are all things that the market is demanding. So definitely continue to see or expect to see a lot of PE-backed companies coming to market. Definitely venture-backed companies, still in play. Definitely the growth story there is extremely important to the IPO markets. But I would say the narrative is a little bit different in terms of we're not focused on growth at all costs or any cost. And really it's about having that tangible path to positive cash flow and profitability, but still expect to see a significant amount of activity in the venture-backed environment. And then you alluded to mega deals. Definitely, I think we'll continue to see those, especially when the market continues to be volatile, because investors look to the larger, more well-established companies as, I would say, safer bets, right, in a volatile market. So I think the good news is we're going to see activity across the spectrum of both sector and issuer type, which is, I think, good news for all of us that operate in this space.
Yeah. Yeah, I definitely, I think we recognize that positive trend of different sectors coming back to the market. For years, tech had been off. When it started coming, I mean, life sciences was active, but it definitely had an uptick in it. It came back, industrials, oil and gas, and there, like to your point, the energy came back. And then, it's nice to see the different types of deals and some very large deals coming through. I think it's giving that variety and bringing some confidence back into the market, and bringing some good capital to these companies. One of the things that we saw resurge in 2025 was the number of SPAC IPOs. And anyone who's familiar with capital markets know that there was a heyday of SPACs back in 2021, over 400 of them in a given year. And we also know that, the regulators, there was some scrutiny from them on making sure that proper, I would say, reporting and just, structure and compliance were followed in order to use that IPO vehicle to come to market. So it went under scrutiny, but, it definitely seems like it resurged significantly in 2025 from at least we've seen. So I'd be curious your perspective on that. What do you believe drove that resurgence, and what kind of companies are looking at the SPAC IPO to, be a target company, complete that merger, and then be a public company? It's just interesting to see it come back. So curious your take on who is taking advantage of that SPAC IPO, or sorry, that IPO vehicle as it's entered the market more and more as of late.
Yeah, absolutely. And definitely saw a relatively significant uptick in both SPAC IPOs and SPAC M&A. And I think the good news there is that there's a number of different vehicles through which companies can go public, which gives them optionality, and I think just makes for a more robust market. Definitely the fact that the SEC rules, were established and people are now used to them and understand them. I think having some time between the rule setting and today has allowed for companies to re-engage in that type of transaction. But you're right, like it's better for certain types of companies and certain types of investors. And so what I would say is some of what I think drove the resurgence is, especially when you have a choppy market, there's always this notion of, speed to market. And I do think you can get a SPAC merger done more quickly than a traditional IPO. I don't think it's as fast as maybe some people think it is. There's still quite a bit to do that's very similar to a traditional IPO. And usually I think what happens is some companies might defer till, after the transaction closes to do some of the readiness work that ideally they would have done before. We certainly saw a lot of that in the 20 and 21 boom. My hopes is that we've learned from that and, companies are going to be better prepared. But I think that is still an element, is just the relative speed of, completing that type of a transaction. And then certainly price certainty is definitely a factor for companies that are looking at a SPAC merger. It does make it, highly attractive. There may be a slight decrease, right, in the premium that they're getting, but that certainty is often attractive versus dealing with the uncertainty of a, traditional IPO pricing model. And then I think maybe one of the most important things is there are definitely sponsors who I would consider, are doing serial SPAC transactions. And we're seeing more of that. And so these are more experienced, reputable sponsors that, I think have increased trust and credibility that they contribute to the SPAC model. And so I think definitely like sponsor quality is a driving factor for where we've seen uptick in these types of transactions. And I mean, I think a SPAC merger, it's not for everyone, but there are certain characteristics of companies that it is an attractive option for. And so definitely, I think for companies that don't fit into that sort of mega deal IPO, it can be attractive for some of those, not quite as large companies, but still high quality. And so it's definitely a path to evaluate. And then I think also for companies that might be in, complex industries or novel industries where the expertise that they get from a SPAC sponsor can really help them tell the story effectively to investors. And so if you think about like what kinds of industries are more attractive maybe for a SPAC transaction, I think definitely companies that are highly capital intensive and align with, you know, some major innovation trends. So if you think about technology driven sectors, again, like some similar themes, AI, SaaS, but I would also add fintech and digital assets in there. From an energy perspective, we've seen, you know, clean tech, advanced manufacturing companies in the sort of energy transition space. That's been a fairly hot sector from a SPAC perspective. And then really once you get into like frontier and deep tech, so space technology, quantum computing, nuclear energy, those are all sectors where we've seen a rise in SPAC mergers. And a lot of that I think is driven by the fact that they do need substantial capital for growth, which, you know, sometimes isn't always best suited for a traditional IPO path.
Yeah, and to your point, there's looking for that capital in today's environment. It's nice to have that vehicle. To your point, the terms and the negotiation can be a little bit more fixed or a little bit more known and not so subject to market conditions. Although those do factor into it, but it is, you know, it is interesting to see that resurgence of the vehicle and people take advantage of that. I mean, I think Chelsea and I, probably months ago, we had an opportunity to meet with the SEC, being back in DC, and talk to, you know, some of the folks in, you know, our political environment. And, you know, the political agenda these days is capital formation. So I think it kind of goes along those lines of what are different opportunities and vehicles that companies can gain access to the capital and do it on the public market. So it is nice to see that vehicle kind of resurge and for companies taking advantage of that. One of the things, I'm going to flip now to our second CPE question, so I'll go ahead and put that up there for our audience. But one of the things, Sherry, you just mentioned, I mean, there is, whether you do a traditional IPO or a direct listing or a SPAC, there's always a readiness factor to it. Traditional IPOs, I mean, I think people go in and there's some set timelines and they probably have some visibility or leading into it know a little bit more, where maybe on a SPAC merger or acquisition, to your point, they become a target company. Maybe they're not as ready as they should be, and then they've got to get ready really fast. But either way, when you look at doing going through an IPO and gaining, you know, capital through the public markets, there is you know, there is a readiness factor to it all. And, you know, what that really means is being able to go through that transaction and operate as a public company. A lot of private companies maybe don't opt to the level or sophistication of public companies from certain standpoints. And so, Chelsea, I'll kind of direct this to you as we start maybe talking about some of those readiness things and how to be ready for that in today's environment. But once a company goes public, it's quickly shifts from, you know, they go through months to get this IPO done. It's, you know, it's a large undertaking. It takes a village to get there, a lot of hours. And then they become a public company. They ring the bell, they're excited. And then day two, they show up and, you know, they are now held to a lot of, you know, new SEC reporting and, you know, compliance requirements. From your experience, I know you work with a lot of those companies. How important is it to have strong reporting processes in place before the IPO? And where do you see companies come up short of that?
So from my perspective, I think when it's definitely important to have strong reporting processes in place, because those reporting processes are going to be put under a lot of scrutiny, and any issues with those processes are going to be magnified like that day after your IPO. I think a lot of companies, when they first IPO, they think, I'm an emerging growth company. I will not have to really worry about SOX too much for the next 5 years unless I have like this great growth or my market cap expands beyond what we were envisioning on day one, or public float for that matter. But I think, and I don't blame them, because I think, you know, you've just gone through the IPO, you've had that party, maybe you just want like a second to relax. But unfortunately, I don't think you should really, maybe take a day, but not 5 years to relax to get those processes in place. And I think where companies struggle is they get so focused on that 404B requirement. And the 404B requirement is where your auditors will provide an opinion on the effectiveness of your internal control over financial reporting. But I think it's important to remember that 404A objective, where management is asserting to the effectiveness of internal control over financial reporting. And your executive leadership, your CFO, your CEO are signing the Section 302 certifications, basically saying your controls are operating and you have a good control foundation in place. And if you don't have good controls in place, even if your auditors aren't opining on the effectiveness of your controls, what I've seen happen for a number of companies is the auditors will come in for the year-end audit, they're auditing your transactions, and they propose an audit adjustment. And I think before SOX, you had an audit adjustment, and it was easy to record that adjustment, and there might not be a lot of discussion back and forth. But post SOX and then the 404A and 404B era, your auditor proposes an adjustment. And even if you aren't subjected to 404B, if your auditor finds an adjustment during the audit, they're going to have to assess if that adjustment is indicative of a material weakness. And so even though they are not signing off from a 404B perspective, you could still be reporting a material weakness in management's report over the effectiveness of internal controls because your auditor found this adjustment. And if you don't have any pulse on your processes and what functions are operating, this is going to be a surprise at the end of the year. And you're not going to have time to even remediate that control before your annual report goes out. So you're going out reporting material weakness that hasn't been remediated. And I think the other thing, what we're seeing in this market, and you and Sherry spent some time talking about the market being good for going public right now. But the other thing that's going on in the market is we're seeing a lot of stock volatility. And when you have volatility in your stock price, I think you are at a greater risk of tripping those emerging growth company requirements. And I have had friends that they were at companies and they were thinking they would have 5 years to get control ready. But then good for them, their stock price took off, but they weren't as mature as they needed to be on the process side. And so the more you're prepared before you IPO, if you are blessed with having a stock price that increases dramatically, you're just going to be much more prepared if you have to if you lose that emerging growth company status.
I think it's interesting looking through as a public company what they deal with, as a newly public company, Chelsea, I think it's interesting you call out the SOX piece in such depth. I think we've seen over the past number of years, and there's many reports published out there that, the majority of the companies going through public, or maybe 1 in every 2 or half of them, are disclosing a material weakness in their, in their offering or their IPO. And so not only are they kind of going in there with, some remediation already that they need to do, but looking down the road and not letting that get ahead of them of what really needs to be done to be able to support the 404B. Sherry, curious from your perspective, Chelsea highlighted the internal controls, but, maybe coinciding with that or in addition to that, you help a lot of companies prepare to go public so they don't get into these kinds of situations as public companies where they run out of time or then they're not prepared. I know you help them through the entire IPO journey. So from your perspective, where do you most often see the gaps of, hey, this is what a good public company looks like, but you're here? Like, how do you kind of reconcile that? Back to the question, like, where do you often see those gaps that exist in those companies and how do you help them navigate that?
Yeah, absolutely. SOX is definitely one of those areas. And I think Chelsea, definitely touched on that very well. A few areas that I would add. So just around financial reporting rigor. So there's typically a relatively significant gap between, what it takes for a private company to issue financials on an annual basis to really uplifting to being ready for a public company audit, and really the demands of SEC filings and that quarterly rigor and all the controls that go along with it. And that's something that takes expertise, it takes bandwidth, and it really takes time to, I call it rehearsing it. And so that's not an area to underestimate the amount of effort that it takes, and can often be that long pole in the tent in terms of actually going through the IPO. And then, like Chelsea mentioned, that doesn't go away. And right away, you've got one day to recover from the IPO and the party, but it's back to work right away. So I think it's important for companies to be very focused on establishing that rigor in their financial reporting, such that it doesn't become like a fire drill mode from quarter to quarter, because that's not sustainable either. I would say another area is just around, and I always refer to this as, sustainability of life as a public company, but it's more around the processes and the systems and the technology that companies use. And one area is, pretty common to see is over-reliance on, manual spreadsheets, especially to support financial reporting processes. We all know that's, prone to error. It's not scalable. It's, more difficult to audit it. It's really just not efficient. And so I think companies really need to take a hard look at the systems they're leveraging and how they can automate processes. It's going to help with their day-to-day, but it's also going to help when they're subject to, control testing. So I think thinking about how to minimize the impact of, manual work and spreadsheets is for sure an area where we see gaps. And then maybe one more would be just around the talent in-house. And, you mentioned the material weaknesses. And this is an area where there often are comments that companies receive around their control environment is related to the talent that they have, and whether it's the right number of people, the right level of accounting and finance expertise, and really just understanding the complexities of SEC regulations and SOX compliance. And those people are in high demand, and especially in a time like what we're in now, where the volume of IPO activity is picking up. Those people are there's not as many of them as what probably all the companies trying to IPO need. And so it's important to get ahead of that and to not underestimate, the uptick in personnel. There'll be new roles, right? SOX will be new, investor relations will be new, maybe bringing tax in-house. So that talent arena is definitely an area that I think companies need to focus on, and it continues even post-IPO.
Yeah, and I think to your point, when you look at the market and the talent out there, there's just not enough. I mean, if you're familiar with the studies done over the accounting and finance industry in particular, and there's other professionals that are critical to this process, but that's an area that really struggles. Enrollment's been down in years. Getting the right talent, I think, is extremely hard to find to kind of to meet like the demands that public companies have at that level that they need to operate. It's interesting we've called out, 3 or 4 of these key things that, are important to prepare in order to go public so you can be a sustainable public company. And I think one of the things that the market's kind of taught us over the last few years is that windows open and close, and they might not be open that long. And so the importance of getting ready or operationally ready to be a public company has become, under scrutiny and more important than ever. But we also know that when markets turn back on, there's a lot of, capital and sponsors and owners that want access to that capital, and they're going to push as quick as they can to take advantage of those windows that come. And maybe Sherry, as a follow-up, like there's kind of a balance there. If these windows open and shut, you're trying to be ready. At some point, there is a moment where let's get done the must-haves, and the nice-to-haves can wait. And unfortunately, that might not be ideal, but it can work. In your opinion, what are the must-haves or the non-negotiables that you have to have ready to go public versus the nice-to-haves, or something that they can address as a newly public company, even though it might not be ideal?
Yeah, absolutely. And, I'll share a few, and you'll probably hear some consistent themes. But, as I mentioned, long pole in the tent, right? The audited financials. I think it's very important for a company to be thinking about their timeline, and, hopefully they're already going through an audit, but sometimes, companies haven't. And the consideration is there a need or a desire to switch auditors? Because that takes time. And really just getting down to the PCAOB level audit, it's a lower materiality. The auditors are going to do more procedures, different procedures. And so trying to get ahead of that. And I've seen companies, they start that PCAOB process early. Maybe they ask their auditors to audit at a lower materiality. It might not be a PCAOB opinion, yet, but at least the amount of test work will have already been done. And so that's something that companies can get ahead of, even if they're unsure of timing, because that is definitely something that can impact the ability to go public. You can't go if you don't have the proper, audited and reviewed financial statements in place. And I wouldn't underestimate, especially for companies who are highly acquisitive, the impact of potentially needing financial statements for, the target companies that have been acquired in the last, 1 to 2 years. That can also be very challenging if the target was never audited, or you don't have a relationship with that audit firm anymore if the transaction was maybe, a couple years ago. So definitely a focus on the financials and trying to get ahead of that. I think also, I mentioned technology to help get rid of maybe spreadsheet reliance. Another place where I think technology is extremely important is in helping companies close the books quickly and accurately every quarter. That's not something that private companies are typically focused on. And I think accelerating the close timeline to meet a 10Q timeline of 45 days is much harder for companies than the 90-day timeline for the 10K. And so really having the opportunity to stage all the activities that need to get done, because it's not just closing the books and generating financial statements, right? It's getting through the review, it's going through board approval, it's drafting earnings scripts and holding earnings calls. So there's a lot of activities that need to get squeezed into that 45-day timeline. And so having a tech-enabled close process, I think, is extremely important in this day and age, and really putting in new tech in the middle of an IPO process is never a good idea. So that's one of those things that companies should be thinking about early. It'll benefit them regardless of whether they do an IPO or not. And we all know putting in, new IT systems can take time. And then maybe just one more, and Chelsea alluded to this, right, is the SOX roadmap. And companies do have a longer window in which to get ready, but I think it's important not to underestimate some work can be done and should be done leading up to the S1, even though there's really nothing required from a regulatory perspective. And so really thinking about that roadmap from a SOX perspective can set a company up for, a more successful and maybe less disruptive process.
Yeah. I think those are highlighted well. I think back to your point on financial reporting, it's sometimes, I know we all of us on this call actually have an accounting and finance background, and sometimes you think your work is the most important work, but it's interesting if you're sitting there with, all the deal team of lawyers and bankers and accountants, and it's like, hey, what's the one thing that has to what's the one, or the large, to your point, what's the longest pole in the tent here? Even the lawyers and the investors, the first thing they always call out is the PCAOB financials. They're like, hey, if you don't have those, call us back when you do, or call us back when when you're going to have those, because otherwise it's incredibly challenging to move forward without having that done. So I just find it interesting, coinciding that even all the other members of the village that help companies go through this recognize what a big uplift that is. I think to your point about technology, again, you have to figure out what resource you're going to leverage to be able to build these sustainable processes. If we have a shortage of people, which we kind of mentioned earlier, and there's a talent gap, I think even more so, especially with AI on top of it. I think when people think about resourcing things now, it's not a people first solve. It's more of hey, can AI or can different technologies help us out there? So I definitely think we're seeing that trend and seeing that change over the past few years as well. I want to pull on a thread because you kind of talked about the importance of close and all the dependencies that happen on close. You close the books and then it's off to the races on reporting from a lot of different parties. And Chelsea, is a public company, I know this is something that you help a lot of our customers with, is that, there is a dynamic once the books are closed and the information's there. A lot of different functions and departments are working with that information to do what they need to. There's legal, looking at risk and compliance, investor relations, earnings scripts we kind of talked about, accounting, as we always know that there's, reporting that goes along with that. But all of those things have to be consistent, connected. There is a process to ensure that there's, that those are done appropriately. So just from your kind of experience, I'm curious how how does that relationship between those three departments need to function in order to be like a sustainable company and have good processes over that?
So I think those three teams you just mentioned, the investor relations team, legal, and accounting, I would think the three of them are ultimately responsible for the timely and accurate disclosures and ensuring consistency in the communications. And I think when you have a 10K and a 10Q, that consistency becomes a little bit more natural because you know the timing, you're going to have control set up around those quarterly processes, that annual reporting processes where your legal, accounting, and investor relations team are meeting consistently. And I think though where it becomes most difficult as a public company is when it comes to current reports on Form 8K. And I'm sure most of our audience knows, but just in case, as a public company, you're required to file a Form 8K with the SEC to announce kind of major unscheduled and material events in between like your interim and annual reporting periods. And so these would be things like significant contracts, acquisitions or dispositions, changes in leadership, and like a bigger one that's come up the last few years is the cybersecurity incidents. And I think the big thing with 8Ks is they have to be filed within 4 days of the event. And so when you're having these issues come up and it has to be filed within 4 days, your investor relations, legal, and accounting teams need to work closely together, and they must know how to properly assess the issues that might require an 8K disclosure. And then once that determination is made that an 8K might be required, they have to ensure that the form is accurate and that it's filed in time and that the right groups of people have looked at it, typically your entire executive team and anyone that has input into the material event that's requiring the 8K disclosure. One thing I know the three of us talked about is we were discussing this webinar, one of the best controls you can have is for these type of events and for your 10K and your 10Q is having a dedicated disclosure committee. When I've been on disclosure committees, this group typically includes your general counsel, your CFO, your chief accounting officer, your controller, and investor relations. I've also seen executives from all parts of the organization represented because you want them all looking and providing input on your disclosures in your 10K and 10Q. And then I think because of the new cybersecurity disclosure rules, I now see more and more chief information security officers or head of ITs being included on the disclosure committee. And this committee typically will meet frequently or regularly, at least quarterly. And that's to support your required periodic filings. But I think crucially, this group also has to be educated on the type of events that would require a Form 8K filing. And they have to understand they might need to be convened at a moment's notice to address events that might be considered material for immediate disclosure in a Form 8K. And I see this coming up a lot, like around the cybersecurity issues is where I think you see maybe the most unplanned response. I think, if you're having a change in leadership, that's maybe easier to know you're going to be announcing a new leader or a new board member, and even an acquisition. But I think with the cybersecurity rules, it becomes even more important for these groups to be able to get together at a moment's notice and understand the rules that might require immediate disclosure. And then I think for periodic filings on 10K and 10Q, these teams, especially investor relations, legal, and accounting, and I would even put in there, I would add a fourth group that we haven't talked about, your FP&A team, because they're going to be putting out guidance in a lot of these communications on a quarterly and annual basis. And if they're all on the disclosure meeting, they can look at all the materials going out and making sure there's consistency between your earnings release, between your 10K and your 10Q, and equally important on your earnings script. You can't be saying stuff in your earnings script or your earnings call that is not consistent with information that is disclosed in your 10K, 10Q, and your earnings release. And where this also becomes important is on your non-GAAP disclosures. You want to make sure you're not disclosing a non-GAAP measure in your earnings script or your earnings release. And if it's not consistent across all communications, if you're disclosing something non-GAAP, that's important for your earnings call, but it's not in your 10K or 10Q and reconciled to GAAP. That's where I've seen you can get a lot of SEC comment letters. If it was important enough for your earnings call, your earnings script, why wasn't it important enough to disclose in your MD&A and have a non-GAAP reconciliation back to your GAAP measure?
Yeah, and I think pulling on that thread, Chelsea, I mean, it just goes to highlight, I mean, we know the SEC, it's not that they don't love non-GAAP, but it is definitely in their purview along with 3 or 4 main other topics where, it is something that they look at intensely, but it goes back to, in order to do that correctly and disclose that information to investors, there has to be this triage of, processes between IR, legal, and accounting working together to ensure that that's done appropriately. I'm going to switch gears for just a minute now, because we've talked a lot about internally what it takes to get ready, preparation, life as a public company. But I mean, maybe an observation that we share from Workiva as we work with companies that go through their IPO and the different advisors that they work with is it truly takes a village to go through an IPO. We haven't seen any companies who don't, hire accounting advisors, legal advisors, investment bankers, even PMOs, IR advisors. The list continues to grow. I feel more and more as every year passes on how many advisors help with this. And it just kind of demonstrates the undertaking that folks go under. And Sherry, you've kind of alluded to it, and so have we, that, when these markets do return and there's active windows, there's a lot of pressure to, take advantage of them. I'm curious from your perspectives, if you lead these practices or you see other advisors, like how do they handle this bandwidth when, it's been off, and then all of a sudden it comes back on at once? Like if the market's steady, that's a little bit easier to forecast and kind of support. But when these big swings happen, how does that impact how, the advisors can show up and help these companies navigate these transactions?
Yeah, absolutely. And it might not always be visible to the companies that we're working with, but I do think advisor bandwidth is, not to be underestimated, and it can prove to be a bottleneck. So I think it is good for people to be aware, and especially when the market window opens, right? There can be a rush to go after the same top tier auditors, accountants, lawyers, bankers, right? And so they have to become more selective potentially in the engagements that they take on. And so I think when those decisions have to be made, I think priority is going to be placed on companies that are more IPO ready and have really spent time focusing on their non-negotiables. Because if they're unprepared, it takes significantly more advisor time. And, you would think, well, that's the sweet spot, right? We want to be able to help as much as possible. But when you're strapped for, talent and capacity, you have to make judgment calls around, the highest and best use of resources. And I think, all of us in this market have certainly dealt with that during the SPAC boom. And, I certainly hope that we don't get back to that, because we honestly, couldn't hire fast enough just given all the demands. And so I think it is important for companies to engage early, internally with their people on focusing on getting ready, but also engaging early on the advisors that they're going to need to support them through this process.
Yeah, and I think to your point, I think there's a misconception out there that sometimes like, oh, if we go, we'll just spend more money, it'll go through the offering, and like that'll be the case. But unfortunately, that's not the reality that we live in anymore. Bandwidth is a problem. To get the right advisors to help you with, there's a lot of complicated deals out there. And we also know that if you're thinking about an IPO, you're probably exploring some other exit opportunities as well. And to navigate those different challenges that come with that, I think the advisors earn their weight in gold, effectively helping kind of navigate some of the complexities with those things. So I do want to highlight that misconception that to think you can go out there and just buy your way through the IPO is actually probably not a realistic, notion in today's market. And so I think as we kind of enter these areas of open windows is something to definitely keep in mind. I'm going to flip to our third CPE question, so I'll leave this up for our audience, but want to maybe flip to our final topic of discussion today. And anywhere we go, it's kind of the first question that comes up. Like if you're helping companies and we're a technology company or a SaaS company, the first question we always get is like, okay, so how can AI help me? What are you doing with AI? Like, what's it changing? When's it coming out? What are you solving with it? And so, you know, Chelsea, as we think about like maybe this process, and I know you work with a lot of our public companies, but what are you seeing public companies, the trends, at least the trends so far of like, what are they relying on for AI as far as, you know, their SEC reporting and compliance processes that exist?
So the most effective AI use cases I've seen for assisting public companies with ongoing SEC reporting involve leveraging AI to research, summarize, and benchmark verifiable SEC filings. And I think the key there, it's important to have a data set or a knowledge base that you're using that's clean and only includes verifiable sources. So you could benchmark against your peers, maybe using a lot of the chatbots out there today, but they're going to be pulling information not just from the SEC filing. They're going to be pulling information from anywhere on the internet. And so that's where I think there are tools out there that are dedicated and a dedicated knowledge base that only includes verifiable SEC filings. So you have a new disclosure, you want to go see what your peers have disclosed about something, maybe like a new acquisition or a new accounting standard, to see what they're saying. It's important to just have that verifiable knowledge base that's pure and clean. And from there, once you're using an AI tool for that benchmarking or that research component, you can actually, what I've seen is ask AI, I've found this peer disclosure, please write a comparable disclosure that I can use in like my 10K or my 10Q. And this is going to be even further enhanced once you, in that knowledge base, include a FASB or accounting standard component, because then you can research the peer filing, you can prompt AI to write a disclosure looking at both the peer filing and then also the FASB codification to meet those presentation and disclosure requirements in the standard. And that's the use cases we're actually seeing in practice now that companies are leaning on. But I think when we look out into the future, and I'm not going to give you a timeline on these, I don't know the timeline, but one that gets people really excited, if you think of your disclosure checklist that you're doing, not only like for your SEC filings, but even if you're a private company, the disclosure checklist is a big pain point. And I think AI is a great use case for helping with the disclosure checklist, because it can look at the required disclosures, compare it against what you've disclosed in your financial statements, and identify perhaps where you have gaps, and then suggest a disclosure that you could include. And then from an agentic perspective, another use case we keep hearing a lot about that I think, you know, some companies are working on developing are AI agents to help with your tie out, whether that's like an internal tie out, a historical tie out. I think the current period tie out's a little bit more difficult to tie to like all the source documents in the current period, but that's another use case. And we have talked a lot about SOX today, so I think I feel obligated to say where AI is helping with SOX. And I think SOX is actually a really interesting use case for AI, and what we've seen presented and we've seen use cases for is using SOX to optimize your controls. So looking at your risk and control matrices, maybe identifying where you have gaps in the process, but also where you have duplicative controls. And then another use case we've seen, or another example, is using AI to maybe upload a meeting you're having while you're performing a walkthrough or getting an understanding of the process, and AI can actually create a process flowchart for you to help with your overall SOX documentation. So your process narrative, flowchart, and then your risk and control matrix.
Yeah. I want to react to a couple of things, Chelsea, but first, Sherry, I'm going to bring it over to you. And, you know, Chelsea talked a lot about what we're seeing public companies look for or use. You know, as you see AI come more into the readiness and IPO preparation and execution process, are you starting to see AI exist there more? And if so, where in that process are you seeing it happen?
Yeah, I'm definitely seeing AI, and probably one of the key areas is it can provide a really great starting point for drafting, elements of, for example, the S1 and the financial statements that maybe don't exist today, right, for a company. So maybe they've never written MD&A before. Maybe they've never had to list out all the risk factors, or they have to think about new disclosures. So I think AI in those situations, partnered with doing peer benchmarking. So, the things that Chelsea was talking about, I think those two hand in hand can really give companies a great starting point. It doesn't eliminate the need for human, intervention, human in the loop, because you definitely want to make sure that those disclosures are tailored to the company and really specific to the company, but it provides that excellent, first step. So I think that we're definitely seeing a lot of that today. And I think maybe another place is when you think about the due diligence that occurs during the IPO process. So I think legal and finance teams I've seen use AI to really digest thousands of documents, right? And look for inconsistencies, maybe disclosure issues. And those are things that in the past, without AI could have taken weeks. And so there's definitely a big acceleration to that process. Obviously, the findings still need to be addressed, and there's some level of human validation that I think needs to occur. But that definitely can accelerate the process as well. Chelsea definitely mentioned the peer benchmarking. Maybe another area that's probably more relevant post-IPO, but I've seen investor relations teams and FP&A teams really access like earnings releases from peers and can digest that in real time, and you get immediate feedback. So maybe there's a peer filer that files earlier than you and your company, and it can give some insights very quickly as to trends that are emerging. So there's a lot of, I think, really neat areas where AI is facilitating this process, and I think we're going to continue to see dozens of new use cases changing every day.
Yeah. And I think to that point, it'll be interesting because your point about due diligence, we know that took weeks and months, and a lot of these processes take a long time. As we start to refine those and ensure that those are validated and accurate coming through, I wonder how it'll impact the timeline and the speed of these transactions and getting through them. You can do diligence for months, but if we can get through that in weeks now, does that cut down a traditional IPO time from 6 months to 3 months or something like that? I don't think it goes that drastic. I think there's still a ton of technical expertise needed and things there, but it will be interesting to see how that evolves. I have one final question for you both. I'm gonna put up the final CPE question for our audience. But my final question on AI is, I think you both highlighted maybe two things that I would call out. One thing we learned about AI this past year is that it's only as good as the data that it has. Like if we don't validate the data and it's not the right data, it can lead you down a path where you're checking it later and it's not right and you're back to where you started and you didn't really gain anything through the use of AI. But the component that I want to ask the question on is kind of the human judgment one. AI is only as good as context can give it. And also what we've seen with AI is it still cannot replace, technical expertise or human judgment or expertise. And we all know in this space that there are judgment calls. There are matters where you have to have a reasonable basis and you evaluate the facts and circumstances of things, and you disclose your best foot forward on what needs to happen there. And so my question to both of you, and I'll go Sherry and then Chelsea, if you can both respond to it, but as AI continues to evolve, where does the equilibrium kind of sit between using AI for automation, but understanding that there's still a human stewardship in the IPO process or, operating as a public company?
Yeah, well, certainly if I think about maybe an area that AI isn't quite, there yet, would be around the storytelling, right? And the strategy. So I think AI is going to be great at assembling the facts and pulling together the numbers, but I don't think it yet can craft that compelling narrative, right? And explain the why behind the numbers. And so that still remains to be a very, human leadership driven task. And so I think finding that balance between leveraging AI for the data, but then really the interpretation and the storytelling that goes along with it is that human element. So I think that's important. You mentioned judgment. Well, we all know there's a lot of judgment around materiality. And so that's not something that AI can determine, I don't think, yet today. And it is very nuanced. So I think you need, whether it's legal or financial or business expertise to really come up with those materiality judgments and calls, leveraging, the guidance that's out there. But we all know it's a gray area that, requires a lot of expertise. So definitely human intervention there is critical. And then maybe the last point I would make is just accountability, right? And you think about the importance of governance over our use of AI. Ultimately, it's still the management team and the board that are responsible for the accuracy of what they put in their registration statements and their filings. And so ensuring that that element of human oversight and accountability remains there. And the AI can't provide that. It's a tool that's an enabler, but it's definitely not going to be who is accountable if things are incorrect or missed or misleading.
You can't just blame it on AI effectively. Like that's
no,
not
even
going
to
work. Chelsea, any thoughts from you? Yeah.
Yeah, and I'll just end with an example of why that human involvement is still necessary and that human judgment is still very much relevant in this world of AI. I talked about using AI for peer benchmarking. I recently used an AI tool to say, compare this 10K filing to that of its peers and tell me where I have a disclosure gap. And so AI did a great job of synthesizing the data and coming out with an output. And it said, oh, your document that you're working on, you're not disclosing finance leases, and all your peers are disclosing finance leases. And so you have a gap and you need to correct that gap. Well, the filing I was working on for that company, they didn't have any leases that were designated as finance leases. And so here, that's just an example. AI is saying, and if you were going to have AI write a disclosure and do everything, they might add a disclosure related to a finance lease component, but that wouldn't have been accurate. And the human with that insight into that company's operations would know we don't have finance leases, so this is not an exception where I have a disclosure gap compared to that of my peers. So just one example of why that human judgment and full human knowledge of the company is very much important, even when AI is helping.
Yeah, we can appreciate the need to disclose sufficient information, but I don't think anyone would want to disclose either unnecessary or other information that could come under scrutiny that they'd have to obviously respond to the regulators with, and what a process that can be.
Yeah, and to Sherry's point, immaterial information. If AI says you have a disclosure gap, but it might just not be material for disclosure at your company.
Sure, which could cause a whole reevaluation on if you set materiality right to the first place if you're disclosing something so immaterial. It brings a lot of questions in that isn't intended to be there based on some of those judgments and things that are made. I want to thank you both. I'll remind the audience that, again, if you had any questions, or please submit them and we'll respond to them. But Chelsea, Sherry, thank you for taking the time and share your insights. It's obviously an interesting topic with the IPO market, seeing the activity we're seeing, plus all the dynamic changes that are happening in timelines or with new technology coming out. So 2026 is set up to be an interesting year in this space. And I just want to thank you both for sharing your insights and taking the time to do this webinar with us.
Absolutely. It was a pleasure. Thanks for having us.
Yep, happy to be here. Thank you.
Yeah. And with that, we'll go ahead and conclude our webinar for today.